Hello and welcome. This is the very first topic under Foundation, the Credit Management Unit. We are tackling the very first topic called Introduction to Credit Management. And basically what one needs to know under this topic is to be able to define and explain the term credit. You should also be in a position to explain the types or costs related to credit. And also it is good to know and also to understand the effects of credit on cash flow, on liquidity, on profitability in an organization. And also another objective of this topic is to understand what we call the types of credit that do exist in the market and be in a position to explain them. So welcome. I hope this lesson will give you a good opportunity and a good chance to know more about credit, even being the first topic, to be able to understand the topics that come after it. So the word credit actually comes from a Latin word. The Latin word is called credere, which means trust. So when you talk about credit, from credere meaning trust. So we also say that this is a transaction. Credit is a transaction between two parties. One party has the goods, the services, and the other party does not have the money and they need the goods or the services, but promises a payment at a future date. So the transaction is therefore conducted on the basis of trust, which now we are saying the word credit emanates from a Latin word credere, which means trust. So trust is key in every credit transaction. Therefore, we say the concept of credit, of course, is to buy now or enjoy now and pay at a later date. The credit sale, we normally say it is treated in the books of accounts as a current asset, since it can be easily converted into cash and a payment is expected or anticipated at a near future. So why credit? I think this is it has a definite answer. Sometimes when we earn, our needs comes before we earn, and therefore we need to consume, we need to have cash or goods, or we need to enjoy some services before we can be able to earn. So this is, credit is a service, or it's a facility needed basically by individuals, by institutions, and even by the government itself. So again, we see that credit can be referred as the oil that drives the economy of an organization or countries or even individuals. And companies are able to sell more volumes when they grant credit facility to their customers. So we see credit as a marketing tool. So why do businesses give credit, or why do we need to give goods and services on credit? One of the reasons why people or customers would want to have a credit facility, it is or to give services on credit, is that we see credit as a marketing tool. That is number one. Number two, credit enable us to create loyalty from our customers, so they can always come to us and not go to other people or our competitors. Another reason why credit is granted, of course, it is because sometimes we cannot estimate the actual consumption. For example, if you ever think of utility companies, like the electricity companies, or like water companies, they normally give credit in anticipation of maybe consumers consuming the goods, consuming the water or the electricity, and then the actual consumption is billed at the end of the month. So this is something that normally happen. So proper credit management therefore needs to be done to ensure customers pay as they have promised to make the payment, and also to minimize the aspect of bad debt in an organization. So when somebody says, or when you hear somebody say that they are in a credit department or they do credit management, therefore they are doing what we call now managing the aspect of credit by ensuring customers are billed, collections are received on time, and also determining how long we are going to give credit to a customer. So the other question we ask ourselves, which is very key and very important, is does credit cost us money as an institution, as a lender? Does credit cost you money? And even it's a question we can also ask ourselves from a point of a borrower. Does credit cost us money? So if you think like a borrower, of course credit costs you money in terms of you'll pay interest for that money. There are times there are other costs, maybe cost of insurance which you have to pay. There is what we call facilitation fee. Sometimes there is what we call we see when they want to, you are giving a collateral. There are charges that are paid to lawyers in form of legal fees. There is what we call the assessment fee to establish the actual value of the collateral that you're giving or you're getting from that organization. So those are costs maybe related to we as individuals, but lenders, they also do incur costs, and they incur a number of costs related to credit. We have a number of them, and one of the cost of credit that an organization incurs is what we call the opportunity cost. Opportunity cost, we can see it when you give customers credit, they don't pay you immediately. Assuming somebody else comes up, maybe your supplier is selling items or is selling goods at a cheaper or at a discount, and you have given all your monies or you have given all your goods on credit to customer and they are yet to pay you, you will miss that opportunity definitely. So you cannot take advantage of the discounts that your suppliers are offering because your money is held by the customers. So opportunity cost is one of the costs related to granting credit that the lenders incur. The other cost that lenders incur is what we call administration cost. Administration costs, these are costs incurred in the process of extending credit to customers. This, we have to have staff, those are salaries. We have to follow up for the debt, so there are telephone bills that we have to pay. We have what we call visits to collect. There's a lot of communication, a lot of paperwork, sending statements, and all that. Those are costs that we also incur, because once you give or once you grant credit to customers, you have to follow up for collection. You have to do a lot of paperwork before that the customers make the payment. The other one is what we call the cost of bad debts. When you're selling on credit, you will definitely incur some bad debts. So not all the credit sales will be paid. Not all the loans that you lend will be paid. So sometimes we end up absorbing bad debts, and these bad debts, we must do provisioning for bad debts. And when you do provisioning for bad debts, we are required to set aside some profits or some of our incomes to cover up the debt that is likely not to be paid. So when we provide for bad debts, it's an expense, which of course affects even our capital. It affects our profitability as an organization. So this is the cost of bad debts. The other one we incur, of course, this one is very common. It's what we call inflation cost. This we of course say that a shilling today is better than a shilling tomorrow. So I would rather my customers pay me today and not tomorrow, because the shilling today is of greater value than the shilling tomorrow. So we incur what we call inflation cost. We also incur what we call cost of financing. Cost of financing. This means before our customers make payment to us, we are normally we need to survive. We need to meet our short-term needs. We also need to meet our obligations that keep on falling due. We need to pay salaries. We need to do a number of things. So we also find that even as a company is giving goods and services on credit, they are also required to take a facility, for example, from the bank in form of an overdraft or in form of a working capital loan or a working capital facility in order to run the business as they anticipate or as they await a payment from the customer. So we can say that indeed we incur a number of costs when we give credit. Therefore, credit is not free. To both the borrower and to both the lender, we all incur those costs. Then we ask ourselves, so how many classes are there as far as credit is concerned? We normally talk about 3 groupings or 3 key categories of credit, and one of them is what we call consumer credit. Consumer credit, it is the form of credit which is extended to individuals, which may be in form of goods, services, or money. And the players in this industry mainly are usually banks, microfinances, SACCOs. They lend to individuals. So when you see the word consumer, it is for consumption. There is an individual who is borrowing either the goods for their own consumption. If it is maybe a car, they are taking a car for their own use. And of course, these facilities are to be paid maybe by installments through for a given period of time. The other category or the other group of credit is what we call trade credit or commercial credit. Trade credit, it's a form of credit provided to businesses, allowing them to raise funds, buy equipment, manufacture and buy stocks. So these are borrowers who don't borrow for their own consumption. They are actually borrowing to run business. They are borrowing to make more money from the business, unlike now the consumers who borrow for their own consumption. So trade credit or commercial credit, they are actually obtaining these goods for onward maybe trading, so that they can now make money. So we could look at it as the traders obtaining credit from manufacturer or credit goods on credit from the manufacturers to sell to consumers and pay the manufacturers at a later date. So that is category number 2. Category number 3 is what we call export credit. The export credit. So what about export credit? Export credit, it's a form of credit that is extended to customers who are outside the border of the country. So when you see export, that means there are exports that are moving from one country to another country. So it is trade between the borders. So why can't we group export credit into trade credit or into consumer? Because when you do export credit, it has its unique features or unique challenges which cannot make them be categorized among trade or commercial credit, which is done within the nation. So when you see export, it is the credit transaction that are taking place or that are being carried between 2 countries, where the seller is known as the exporter and the buyer as the importer. Then the other one, merits of credit. What are merits of credit? Of course, we see credit as a wealth creation tool because it helps institutions to acquire wealth on credit and then pay at a future date. It's also looked as a tax planning tool. When we borrow or when institutions borrow, the interest that is normally charged on the borrowing actually is a deductible expense. So this one helps them to retain some of their wealth within the business. The other one is, of course, it has conveniency. It's a convenient way. Credit is a convenient way of raising capital. If you do not have capital for business and you get individuals to fund you or to fund your business, then you are able to run a business. So it's a convenient, and sometimes obtaining credit would be much easier other than maybe waiting until you accumulate your capital to be able to open a business. Then we also see is credit as a business control. What we normally say is that you can't lose your business. Somebody else cannot take over your business because you have not paid a debt. Unlike maybe, how do I equate this? So we say that if you take goods and services on credit, you still remain the owner of the business. It's not like bringing shareholders on board who come and dilute your shareholding. So with credit, you are able to still control your business, to be the owner of the business, and to run the business. The other one is what we call socio-economic advantage. Of course, credit enables creation of jobs because when when people are able to obtain credit facility or goods and services on credit, they're able to consume more, and of course they spend more, and they spend more, of course they will be enabling those institutions to grow and be able to create employment for others. Are there demerits of credit? Of course, credit has its own demerits. And the demerits of credit, maybe one we can talk about reduced profitability. Yeah, because their borrowing costs, we see. So when there are interests that are charged, when there are processing fees that are charged, of course, those are expenses that the business incurs as far as borrowing is concerned. Then, of course, when you default, of course, you get what we call bad reputation. Maybe you might be listed with the Credit Reference Bureau. People may be coming to your business every morning to demand for their monies. This might make you have a bad name. Then the other one is sometimes we've seen businesses or individuals get into bankruptcy. And of course, when you're bankrupt, there are a number of things you cannot do. You cannot hold a public office. You cannot even own anything. So a bankruptcy also has its own disadvantages. Then there is the other one, of course, your propensity to spend. When you are getting goods and services on credit, there is a certain appetite that comes. Sometimes you don't even think about it and you just want to spend and spend and spend. So those are some of the demerits. So most important now, as I conclude on this topic, is that you should be in a position to define what credit is or what credit means. So we have seen that credit, this is a transaction between two parties, or it is a contractual relationship between two parties, one providing goods and services on credit and the other one is expected to pay at a future date. So that is most important, what you need to understand. Then there is what we call a credit cycle. In credit, there is a credit cycle. What is a credit cycle? The credit cycle basically shows a step-by-step process or procedure that take place before maybe a customer becomes a debtor. So when we talk about the credit cycle, we talk about three number of factors. One, we look at the customer acquisition. Customer acquisition, this is through marketing. That is step number one under the credit cycle. Customer acquisition. Two, credit application. The credit expresses their need for credit. And then there is the aspect of credit processing or assessment analysis is done, and of course now funds are disbursed. Then we do what we call credit monitoring. The monitoring, what we call credit monitoring. This is now bookkeeping, housekeeping, making sure the customer accounts are in good shape. And then we find ourselves now into collection. We do the normal collection, following up, making phone calls and all that to do collection. And then eventually we find that some may not pay. So we end up with debt recovery. So what about debt recovery? The debt recovery, we normally now involve maybe debt collectors, our in-house collection, a collection team. We also sometimes engage even lawyers who will make a legal demand, and eventually maybe the court of law is involved to recover. So that gives us a basis, and under that topic, as we have looked at the three types of credit, the export, the consumer credit, and the trade credit, our next three topics, actually, they expound more, or they talk more about the three groups or the three key categories of credit in an organization. I hope that gives you a good basis, or that gives you a good introduction to credit management, and we can be able now to build on what has been left. Thank you so much for listening, and in case of any question, you can always get in touch through the contacts provided. Thank you.